on this.
Goes to the house next
My
door.
name is Jerzy Wojcicki, and I'm here from the
You and
Taxperts
clients just
group
look like,
with my colleague Adam Serota, and we're here to talk about income tax for real estate agents and anything that has to do with tax that real estate agents may be interested in. We'll talk about income tax, HST, property sales, HST on property sales, and maybe rental properties and things like that. So without further ado, I will start by talking a little bit about income tax system in Canada. So in Canada we have a progressive tax system. Here are income tax rates and thresholds for individuals.
Sorry, we're gonna email your office the slides.
Yeah, we will email you exactly what
Okay,
we
thank you
show.
so much.
Like I said, income tax rates and thresholds. The joke goes, if you know income tax rates and thresholds, you can call yourself a tax advisor. And it's probably true. So the idea is for you as an individual, you're filing your tax return as an individual, self-employed individual, your net income from real estate activity is taxed at different rates, depending what tax rate you end up in addition to any other income you may have. So these rates apply to taxable income, of which your net self-employment income is a part of. The highest tax rate you can possibly pay in Ontario is 54.5%, and that's a combined federal and Ontario rate plus Ontario surtax, which is about 50% of all Ontario tax you can pay. That's courtesy of the last Liberal government. Just several points. Tax, think of tax as literally as cash. This is something you're gonna have to reach to your pockets and pay, or you will get money back from the government in terms of a refund. Not very likely for you, but this is something that's literally equivalent to cash. Two things I want to talk about is the tax-free income. There's only two you want to be concerned about, because there is not much else you can do as a sole proprietor, and this is tax-free savings accounts. Income generated in a tax-free saving account is tax-free, and principal residence exemptions, meaning if you own your principal residence, you sell it, there's no tax. It's exempt from taxation. There's no other tax type for you that will be completely tax-free. It just doesn't exist. It's low tax income, which is dividends and capital gains. Dividends is, if you receive dividends from corporations, that's you will basically get the tax credit for the income paid on dividends by the corporation. It's not much help if the corporation is yours, because now you pay the tax in the corporation and then you give yourself tax credit for the tax you already paid. But if you get the dividend from a public corporation, then you will pay a lower tax rate by the amount of dividend tax credit. And then there's capital gains. Capital gains is basically taxable at the 50% of any other income you may have other than dividends. There's also deferred income, such as RSPs and brick depreciation. RSP, so when you make a contribution, you get a deduction by the amount of RSP you contribute. However, if you cash that RSP later on, you will have to pay tax at a later date, at the rate, at whatever rate you will be in that year. The idea being when you retire, your tax rate will be lower than what you're paying now, so it makes sense in that way. Brick depreciation, that basically means that when you have a rental property, you can depreciate the building at the rate of up to 4%, and that will reduce your taxable rental income down to 0. You cannot take a loss by taking brick depreciation, or you cannot reduce any other income by taking brick depreciation on your rental property. The reason it's deferred is because when you sell your rental property, the brick depreciation is recaptured. It's just like redeeming your RSP. So in the year of sale, you will pay tax on the accumulated depreciation you paid during the useful life of the rental property. There's another type of depreciation which is on appliances. You can break down the appliances from the cost of the property and take 20% on that, and that's not subject to recapture. In fact, it's subject to terminal loss, meaning you can, at the end of sale, you can just write it off completely and there will be no recapture on that. Just move to the next slide. So as a real estate agent, when you file your tax return, you claim expenses, and there's different categories of those expenses. What we did is we came up with a spreadsheet that makes it easier for you to categorize your expenses for the purposes of filing a tax return. You can download this spreadsheet from our website, and you can populate it by just scrolling to the right. You will enter all your receipts, and it will categorize them for your tax return, and it will break down the HST, because you have to take out HST and claim them separately. There is a separate return for HST, and your HST expenses don't belong on your income tax return. There's room for your car expenses and home office. As a real estate agent, I suggest you claim home office, even if you work here most of the time. The only reason you wouldn't want to take home office is if you pay commercial rent somewhere. It's probably not happening for most of you. So you can deduct a percentage of whatever would be reasonable where you live. So if you have a $3,000 square foot house, claiming 1,500 square foot is probably not reasonable. But if you have a condo, then up to 20% of that would be reasonable to claim as home office. And for car expenses, you can claim anywhere up to, and not quite 100%. Never claim 100% on the car, because CRA, not only will they not allow it, they will use this as an excuse to go back in time and say, hey, this is unacceptable that somebody can be claiming 100% of car expenses, and they can potentially audit you more than you want. I mean, going back. So that's pretty much it for the spreadsheet. We're moving on. We touched upon this principal residence exemption. Do you want to talk about it? My colleague Adam will take it from here.
Okay. So there are really, it should say 4 types of treatment on a residential home. Sorry, 3 types of treatment on a residential home. I know it says 4, but let's just go with 3 categories here. Principal residence that Jersey talked about. In theory, you could have a mixed-use property, a mixed principal residence and capital gains. That's why the 4th, but it's a little more complicated. It's very rare. Principal residence, number 1, everyone really knows what principal residence is. It's the house you live in. Okay. Second type is capital gains. That's, let's say you have a capital gain of $100,000. $50,000 of that is completely tax-free. You can put it in your pocket, and then the other $50,000 gets just added to your other sources of income. Okay. So that's a very reasonable rate of taxation. And the last type of taxation is full taxation. The entire gain is put into your income. That's for people who are flipping properties. Okay? You're all real estate agents. sale of offers, and people who you know are flipping, are likely flipping, are not going to get capital treatment. The entire gain is going to be put into their income. What's the difference between capital and full taxation? There's a lot of hundreds, if not thousands of cases in court on what is the difference. There's a variety of factors. They'll come up on another slide, but one is expertise in real estate. That's everybody in this room. You're all experts. Number two is frequency of transactions. If you move 5 times in 4 years, you're probably flipping properties. If you move twice in 5 years, we got some wiggle room, right? You bought a 1-bedroom condo and surprise, you had twins, right? That's the idea. You can move for a reason. We recommend that owners of rental properties, we know that we're going to talk about assignments in a second. I know that's a hot topic for everybody. We recommend holding on to a property for at least 18 months after you get title to try and make sure you get capital treatment. 18 months will usually straddle 3 tax years. It's pretty rare, I guess in theory, if you close in January, that could be 2 tax years, but that's going to be a rare occurrence. So CRA is going to see rental income declared for 3 years. That's pretty good to get capital treatment. There's no law, there's nothing in the Income Tax Act that says you have to hold on to it for this long to get capital treatment. Nothing, it doesn't say. 18 months is just a general recommendation. Okay? Now we're going to talk about flipping of offers. Every single one of these will be caught by CRA, and CRA is auditing every single one. Not to be blunt about it, but you're toast. Right? I mean, it's very easy. And I'll tell you what CRA is doing is they're demanding a CD of all the original agreements of purchase and sale from the builder. And nobody wants trouble with the CRA. The builder happily provides in exchange for perhaps not getting audited. Okay? That's a bit facetious. CRA could just turn around and audit them anyways, because they're CRA. So what they do, it's very easy. You get a digital copy of all the original agreements of purchase and sale. You compare that to the land title registry, and if a name on the purchase and sale is different than land title registry, someone sold the offer. It's really easy. It takes 2 seconds to do an entire building, because usually, they close in chunks, right? The condos, they'll do like 10 floors and then 10 floors. Very easy to catch, okay? Like I said, CRA is auditing every single new construction development in the GTA and in Vancouver and up, yep.
Is there a lot of that going on?
Our record is one guy had 12 flips without declaring assent.
Wow.
Okay? Our job was to keep him out of bankruptcy. He succeeded, and he is writing a humongous check. It's a lot. There's tons of it going on. Tons.
There is.
Yeah, especially so interesting is now there's a lot of it going on because people can't close on their mortgage. I had someone call me, I swear to God, yesterday, saying I sold my assignment because, and also this guy, it wasn't because he couldn't close. Let's say, okay, I'm not going to give him away, but he bought a place in Mississauga and got a job in Oakville, or in Pickering, let's say. Well, he's got to move. And the problem is some of these condos take forever. This guy's waiting 5-6 years, and finally it's close to done, and he got a new job. That's the truth. He made a $70,000 profit. Okay, so we're going to use him as an example. He did not make $70,000. CRA is going to take most of that. Okay. What's going to happen is if you don't declare it, right now CRA's position is you're going to have 50 cents on the dollar penalty.
Did he have another home at the same time?
He was renting at the time.
He was renting, so that's his primary.
Isn't that one of those circumstances where it's out of his control and the CRA has to accept it?
Nope. CRA doesn't accept anything. Not to sound harsh and rude about it. It's extremely rare, and we don't even talk about it really. It's extremely rare CRA will grant capital treatment on an assignment. For sure, it's not a principal residence. Principal residence exemption, the law clearly states you physically have to move in. The law states ordinarily inhabited. You can't ordinarily inhabit a condo that's not finished. Right? We can all just agree that that's not happening. You're not going to claim I was living on the floor and while the construction was going on. It's not happening. So
I guess that's fair. He made a good investment then. As it turns out, he made.
Yes and no. Let's do some math here.
Yeah, what did he pay on tax?
Let's go through that. He makes 120 grand. Is this okay? I'm going all off top.
Yeah.
That's okay.
Okay. He makes 120 grand a year. So at 120 grand a year, he's right here, he's paying 46%. Okay, so we got, his gain is 70,000. And if you can't read my handwriting, I'm sorry, it's the 21st century, my handwriting's terrible. So he makes 70,000 bucks.
So that's 35,000.
Nope, it's worse. This 70,000 is subject to HST. Because offers are more than likely going to be taxed as fully taxable business income. And CRA is going to tell him, and I'm saying this from experience, we've done over several hundred assignments. This is inclusive of HST. So 70,000, break out 11%, how big Jersey?
11% or 13?
13.
13%.
No, I know it's
13%.
13%, but
Oh.
what is 13% of 70,000? So 100,
Nine-
so
seven,
95.
7, 3,
9,
7,
1 is right.
9,
Okay,
10,
let's
yeah,
go with
9, 10,
9,
91, yeah.
I'm just gonna say 9,
Okay,
just
use
for
9.
ease of math, okay? So 9,000 is going for HST. So he's left with
61.
61.
61.
So income tax, he's left with 61K.
Any other expenses he's got?
70,000 was after expenses.
Oh,
So
okay.
the real estate agent is
Okay.
off the top.
Okay.
Okay, 61,000 is taxed at about 45%. So you're looking at about 27,000 bucks going to CRA again. So let's write CRA up here. They're gonna get 9 grand plus another 26 roughly.
Sure.
Sure. So really, 26, that's 125, that's 35,000 he's gonna be left with. Okay, not great.
It could have lost.
They punish you.
You could have lost money.
You've done it with
Yeah.
35K.
Yeah.
Yes. Okay, well, it's about to get this, you're just at the start of this talk, we're gonna go down that road a little bit more, it's gonna get worse, okay?
Oh, I know.
Okay, so, it's, assignments are very difficult to get capital treatment, I can tell you, like I said, we don't put it in the slide. We had a client who, it's a true story, about a 1-bedroom condo, they had twins, took forever to build it, they had twins, and we were gonna drag them into court with the twins, and they were ready to tell the judge with the twins sitting in front of them, you two were an accident. And that was going to happen, and CRA eventually relented and gave them capital treatment. But with your clients, you know, our advice is do the math, assuming you're paying HST, assuming you're paying full taxation, and then see if it makes sense. Because that's the most likely 99% scenario.
So the guy with 12, did he get treated as capital gain or as a profit?
Okay, sometimes you make a deal with CRA. The vast majority of them were profit. What we really saved him from was the 50 cents on the dollar penalty.
Oh.
Okay? 50 cents
for
on the
lying,
dollar.
for lying, basically, is that what it is?
Yeah, that is what it is.
Okay.
Yeah. 50 cents on the dollar, and just because it gets better, they're going to charge you interest on that 50 cents. Okay, so as you can imagine, if this guy was subject to 50 cents on the dollar penalties plus interest, that 70 grand is just gone. It's gonna go, okay? We're encouraging people because CRA is auditing all these assignments. You have clients who have assignments, number one, they have to report it. Number two, they could file a voluntary disclosure after the fact. Come forward, disclose your income, and the voluntary disclosure is really the only way you can get out of those 50 cents on the dollar penalties, virtually guaranteed. CRA finds you, you're paying us a lot of money to negotiate on your behalf, and it's hope. And CRA is getting harsher and harsher on those penalties because they're looking for money. They're not your friend.
So this guy with that got transferred, his was treated as that capital gain.
No, he called me yesterday and I told him he will likely not get capital treatment. And the reason is because CRA is going to tell him, and this is, CRA's position in this area is always evolving to an extent where they can get more money.
Yeah. Okay. Yeah.
Okay?
Of course.
They change positions all the time. Nobody who drafted the Excise Tax Act and the Income Tax Act fathomed assignments on the scale that we're seeing right now. It just wasn't, in 1991, they didn't consider it. They didn't think about it. I see a lot of nodding heads. It's the truth. The Income Tax Act, for example, was drafted in 1972. Assignments weren't on the radar. Okay, the CRA's position is that if you can afford to close on it, you're supposed to, you've entered a contract, and all you're selling is a piece of paper. It's not a piece of land, it's not a piece of property, it's just essentially an option, okay? And that's why, in between you and I mean, there's some truth to that. This guy I'm talking about could have easily afforded to close it, easily afforded to rent it out, and it's also part of a wider policy that CRA is pushing for more rental property to come on the market. They don't want people flipping assignments all over the place.
The CRA wants more rental
It's a
property?
policy from finance, comes from the government. Okay, we're going to talk more about that. Everything in tax has a why. So nobody here is a real estate lawyer, right? Okay, I've said this at the talk this morning. I made a joke about real estate lawyers. Eventually, one real estate lawyer is going to call me and he's going to be pissed. Okay, real estate lawyers. If you go up to them and say, like, why is this form like this? The answer is going to probably be, we've always done it like that. Right? Let me think about it, but we've always done it. Everything in tax has a why. Everything in tax has a why. And if it's a policy from finance, if it's a policy from the government, tax is the policy vehicle of every government. When we want to encourage more babies, you boost the Canada Child Tax Benefit. That's how you do it. It sounds facetious, but that's how you do it, right? We want kids to be more active, give them a fitness tax credit. Everything in tax has a why, and it's usually policy. So taxing full gains of regular income. These flips are big business for CRA right now. It's huge. Like I told you before, there's factors. These are the factors that they're going to look at when they're determining if it's capital or business. And there's a 3-year limitation period. So everyone gets their notice of assessments. That date is a lot more important than you think. That date, CRA has a 3-year limit to do whatever they want with that tax return. They can ask you for any piece of information on it for the next 3 years. There's no restrictions. Some concerned faces. So they can do whatever they want. Going past those 3 years, they need to prove what's called a misrepresentation, and it's attributable to carelessness, willful default, or neglect. Okay, trust me on that. It's not a very high bar. The courts have let CRA get past that pretty easily. If you have undeclared assignments or undeclared real estate transactions, that's going to be the test, very likely. The only way you're going to use that test to save you on a real estate transaction that you did not declare is if you have concrete, verifiable proof that you lived in the property. Okay. So, and again, everyone knows in 2016, I think it was 2016, that they made us now actively declare your principal residence exemption on your tax return. So if you sell your principal residence this year, or last year, 2018, you have to tell your accountant before you file your taxes. It has to show up in your tax return. Prior to that, it was CRA's administrative policy. It didn't have to show up on your tax return. Now it does, and there's big penalties if you don't.
So why are they doing that though, if you're not having to pay tax on it? Is it just to find out what your worth is? What is it?
That's one, yeah. So it could result in a net worth audit, which is a net worth nightmare. And number two is that if you have multiple transactions, CRA, some people what they've done. So for example, the principal residence exemption says you need to live in the property for a short amount of time. I'll give you an example. Your cottage qualifies. Your cottage is a principal residence, even though you only spend the summer there. So for a lot of people, let's say they dispose of the cottage and the condo in the city in the same tax year, they're going to want to play a little bit of math games with the principal residence exemption, and CRA is trying to figure out what they're doing with that. So that's another reason. And you're right on it. You're bang on the money with the net worth thing. The amount of money that's going around in real estate is unprecedented, and CRA is trying their best to get a piece.
What about married couples splitting up, one living in each property, if they have two properties, cottage and a house?
Yeah, it's usually not a disposition. It's only dispositions that need to be declared. Like you're saying, if they split up.
They split up, then they sell them. Both sell.
Once they dispose of them?
Yeah, so there'll be principal residences for when they were married, and yes, there'll be principal residences thereafter. So a married couple gets one principal residence.
Right.
When you're divorced, people,
no, say
I'm not
that-
encouraging you to get divorced.
No, no, but
get
say
the
that,
principal
no, but
residence.
they can even do.
No, but if you have two properties,
Yeah, the
one
husband,
stays.
the husband
Correct.
stays in the house,
You'll have, so.
and then the wife goes to the cottage.
Okay, so how, yeah.
And is your capital gains from the cottage from before they moved
Yes, the
in?
answer is yes.
Okay.
The answer is yes. When,
Okay.
for the time period that they're married, they can only have
Ah.
one.
Okay,
And it's a year-over-year calculation. That's, I see your
yeah,
question, yes.
yeah. So better if they had been,
Yeah, it's
never
not
got
worth it to
married,
get divorced
leave bought
just 'cause
bought it
you-
separately, yeah.
Okay, so again, full gains on real estate is something that's coming alive, okay? Unfair audits of real estate agents, this is commonly known. Real estate agents are, percentage-wise, much more likely to get audited. That's some schmutz on it. Much more likely, percentage-wise, you're all independent contractors, you're all small businesses in a sense. At least your tax return looks no different than a small business. Receipts and vouchers must be totaled. The spreadsheet's a really good tool because we just hand the spreadsheet to CRA. Okay. So the test of whether or not something is a business expense must be incurred to produce income. Your yoga mat, not an expense, not a deductible. That's a classic. Broker annualizes
Gave it as
statement
a
serves as a receipt for your
Yeah.
broker fees paid. You have to make sure you keep all your broker sheets that Keller Williams gives you. There's going to be a lot of expenses on there, and that's critical. The gift dinners, events need names. This is something that real estate agents are notoriously bad at. Sorry, that's the truth. You have to write the name, and you have to keep a list of everyone who you've given gifts to.
Really?
Really, really, yeah, really. Yeah. Okay, so
I give gifts to strangers though.
make them your friend and get their name.
Just write any name.
They're gonna get gift cards,
You're
right?
doing- What about entertainment? You're doing
$10
Define
gift cards.
entertainment.
a dinner party and you brought your clients or.
Yeah, you need a list of the clients who are there.
What if you just make them up? Like, they are actual people, but you didn't know if like Bob Smith was at your house that
Yeah, how do
night,
they
and you
know?
just like put it down.
So
You
what's
don't
your,
have to give the
okay,
last
so,
name. Privacy issue.
We have like
Number
hundreds
one.
of receipts.
yeah, you can have hundreds of things, that's true.
In a
Your
year.
CRA's policies are supposed to write a name for all of them,
On the receipt.
okay? On the receipt, just write it on the back.
So you could just
Very
write
good
Bob.
tip. They're gonna ask you who Bob is, and there's a fine, and as a lawyer talking to you, there's a
Right.
big difference between not telling CRA everything and out and out lying to CRA.
Right.
And once you lie to CRA,
Yeah.
that's, your era of credibility is over, and they will catch you, and, well, they will likely catch you, and then they're gonna ask for, your negotiating position on everything else has gone down,
Little
if
peanut.
they catch you lying. So a good thing is that, for example, if they see, they're gonna get you a list of your broker list of all your commissions. You know, if you took, if Bob Smith is on there, they're gonna believe you that you took him out for dinner.
What if you've been working on Bob Smith for their business?
So show me some emails. Show me your calendar that shows you met with him. I know you have an Outlook calendar. I know you keep some appointments in there. Okay?
So my experience
Isn't there
is
privacy issue?
Yeah.
when you write the name at the back of the receipt and you say, you know,
Yeah, isn't that a
Joe
privacy issue?
Blow,
though?
Reed, 2200 Young Street, that's
What?
the end
No
of.
privacy laws here.
That's right, that's
that
what I
doesn't mean
understand.
that They will not be asking who's Joe Blow.
Yeah.
Yeah,
What's
they're-
the phone number?
Yeah,
The chances are low that they'll ask, but, you know, we encourage our clients, don't make up
don't
salaries.
use Bob Smith too much.
Sorry? Don't use
Don't
Bob
use
Smith too
him
much. That's, I swear to God, I have a cousin named Bob Smith who lives in Sacramento, California. I swear to God, he's the sheriff of Sacramento County.
Katie, Greg's
That's
funny.
a tough name.
Yeah.
Bob Smith.
Okay, anyway, so we we are telling you the letter of the law, the absolute rules, so that if you do the best you can, at least we're ahead of the game if you get audited. Is that fair?
How long does it take to get to court?
Uh,
Because it's shortage of court time and all that other stuff. There's a lot-
we can talk about that. The answer is years.
Okay, yeah.
Years and years, and I do tax court for a living. The chances of you actually seeing what I call the eyeballs of a judge
Mhm.
are extraordinarily low.
Yeah.
It just doesn't happen anymore. You make a deal. Keep records for 6 years. CRA can do whatever they want for 3 years. 6 years is what it says in, I think it's section 230 of the Income Tax Act. Bank records, though, go back 7 years. Your bank records are not a secret to CRA. They can just ask the bank for your bank. Okay? CRA will, when they're auditing, especially real estate agents, the auditor's looking for money. They're in tax grab mentality. They're looking for a reason to get some money out of you. The more records you have, the better organized you are, the less reason they can't just make it up. They can't. So, like I said, the home office, no proof of meeting clients at home. Jersey touched up on that. That's ridiculous. And a car. They're going to tell you you need a logbook. There's really not a lot of truth to that. There's nothing in the Income Tax Act that says you actually need a logbook, but practically speaking, the burden of proof is always on you to prove you're driving. You seriously doesn't have to prove anything for anyone. They can knock down all your expenses to zero, and it's your burden of proof to prove that you're using your car for business. A good way of doing that is your Outlook calendar. That's just, if you've got a lot of appointments there, everyone here has some sort of calendar to keep track of their appointments. It's a good idea to write down the address. You're already putting it down. I'm meeting, like if you're writing poor Bob Smith, we're picking on Bob. Meet Bob Smith at Starbucks. Just write Young and Lawrence. And a good thing that we've done in the past is just print out a month-long calendar for a client of ours. Say, we usually give June, because real estate's busier in June, and just say, here, this is a driving synopsis of 1 month, multiply it over 12. Only one time was an auditor so savvy that they said, real estate's more active in June, I want to see November too. That was clever. I'll give it that.
Is mileage calculated from the office or from the home?
No. If you're claiming a home office, every time you leave the driveway, you're on driving. If you're claiming a home office, if you qualify for a home office as well. Real estate agents, it's extraordinarily rare that, like Jersey went into, that you're paying commercial rent. If you're paying commercial rent, then it's from the office, yeah. But real estate agents, for the most part, don't pay commercial rent. Okay. Again, your bank accounts are not a secret. They're looking for anything in personal in nature. Okay, denying principal residence status. This is a very, very hot topic. CRA is looking for what we call serial movers. If you've moved like I said at the beginning, if you moved 4 times in the last 4 years, you're probably moving for a living. Like one of those clients right now, she moved 4 times in 4 years. It's an uphill battle. They're denying principal residence status, and as you can imagine, the gap between 0 tax on your gain from your home to full tax is humongous, plus interest. For CRA is always 3 or 4 years behind the market, so right now they're just getting at 2015, 2016, think about it that way. If you bought in 2012 and you sold in 2016, you would need probably some sort of skill to not have made profit in Toronto. Am I right? I mean, it's just unheard of, and that's what CRA is going after. Okay, CRA doesn't audit in real time; they're always 2 or 3 years behind. Levying 50% penalties really is a disgrace in a lot of cases. The law has been clear on this. Justice Hogan, he wrote it. Ordinary habit, even for a short period of time, qualifies for the principal residence exemption. That's the cottage. Okay? And what everyone asks, what does a short period of time mean? I don't know. I don't know what a short period of time is. Mostashari was a case of mine. Don't worry, Mr. Mostashari knows that he's in this presentation. He's a super nice guy. Actually, when you go to tax court, when you file into tax court, it is 100% public. So that's just a reality. I didn't have to ask him his permission. I could have done it anyways. Just I like him. Mr. Mostashari lived during the occupancy period. The occupancy period is always a big fight with CRA, whether or not that is considered. It's kind of hard to prove that someone lived there during the occupancy period, but he lived there for the occupancy period. He sold it shortly after getting title, but he really did live there. He really lived there. He had internet, had friends over for beers, had an ex-girlfriend who was going to come testify, and we had everything. No doubt about it, he really was living there. And CRA eventually relented that, okay, he qualifies for principal residence. Now, Mr. Mostashari couldn't get a job. He graduated U of T engineering. He had trouble getting a job. The story ends nicely. He did get a job eventually, and he's doing quite well for himself.
Where's he living?
Right now? I'm not telling you that. But I can tell you this, because in the court case, if you go down to the court and get the documents, he moved out to his parents' house.
Yeah.
Okay, so it's he told them, I can't afford this condo. Well, if you go from that condo and you buy a more expensive
Yeah.
condo, that doesn't really make sense. He moved to his parents' basement. It was the truth.
Yeah.
And his parents, were trying to help him out as much as they could. So he got principal residence exemption, and they waived the penalties, which were outrageous. The penalties are extremely high burden for CRA. The courts have put it as close to criminal conduct. It's 50 cents on the dollar, so it's significant, and it's knowingly filed. They have to, you have to have some knowledge of what you're doing when you file your tax returns. Okay, it's very rarely imposed, but CRA is getting more aggressive about it. It's a tax grab. That's what it is. They're looking for money. HST on new homes. You can walk around this neighborhood. You can see some of our files. HST on new homes is people bulldozing a house, rebuilding it, and putting up the for sale sign. You've just triggered HST. It's a big problem. Once HST comes, it's rare that you made money. Residential home flips are being audited, almost all of them in the GTA. Last November, we got our first files from Oakville. And CRA is obviously looking at Oakville. CRA last March went to the City of Toronto and they got all the building permits. So they're looking through the building permits and the occupancy permits. If you knock down a house and rebuild it and sell it for a profit, you have to charge HST. You are no different than Minto or Mattamy Homes, you're just on a smaller scale. Policy-wise, really what's the difference between building a condo and bulldozing a house and putting up a new house? There's no real difference. Newly construction homes are subject to HST unless, you can read that, that's just a copy and paste from the Excise Tax Act, Section 191, sub 5. What it is basically if you build your own home for your own personal use and you intend on living there, if you're just building your own dream home, you're not subject to HST. In fact, we get you a bit of a rebate.
You paid it already anyway. When you build it, you buy all the materials and pay the workers.
That's right.
HST, you paid
That's
it.
right, yeah. So you paid it, but when you build a home for profit, you have to charge HST when you sell it.
Yeah, but you get it back.
You can claim your construction expenses that you prove, but the problem with HST is construction mortgages right now are about 9%. There's no HST on a construction mortgage. There's no HST on the purchase price of the land. There's no HST even on your first mortgage that's probably around 4 or 5%. There's no HST on land transfer tax. A lot of expenses don't have HST, and if your clients are planning on buying a lot, bulldozing it, putting up a new home, and selling it, you gotta be real careful about the HST.
If the builder's
That
buying,
was very on time.
if the builder's buying a lot to build
Yep,
a residential property, isn't there HST on that lot?
no. Usually it's all in this area, for example,
Yeah,
it was old people.
yeah.
Those old people have principal residence exemption, they're not charging HST.
And
Can you now talk about the difference between a new build and a renovation, or that's a different class?
That's a course of my master's degree. But what the test is, and you can look this up, it's called substantial renovation. Okay? And if you're really savvy, you'll look at section, oh God, that's awful, sorry about that. Section 123 of the Excise Tax Act. Okay? There's a definition in there, it's horribly drafted, I don't know what they were thinking, but it basically, once you substantially renovate a property, you've triggered HST. What does substantial renovation mean? Look, everyone knows when they walk into an open house if the house has been gutted. You know it when you see it. That's the best way I can formulate the test. Okay, that really is. So CRA's position is that 90% of the home has been replaced or renovated,
That is a new build.
and it's a new build. Yeah.
So how do we protect our clients from putting an offer to buy a property that they say is being renovated, but it's clear a gut job? You just put HST included if they sign it?
Always put
repairs?
HST included.
included,
Always put HST.
But then, does that mean the clients are safe to go.
The buyer's okay.
The buyer's
The seller
okay.
might get nailed.
Yeah, the buyer's okay, unless you're buying from a non-residents don't have to charge HST, forget I said that. But we're gonna talk about non-resident taxation in a minute, that's always a problem. And if you wanna be very savvy with your buyers, if you think they gutted it, or you think it's a new construction and you think that nobody lived in it prior to you, if you wanna help your buyers, you can have them call us, come in for a meeting, we can get them a $24,000 check for HST rebate.
If they pay.
No, doesn't matter.
Well, even if it's
If you
included.
buy a house that's newly constructed
Okay.
and CRA agrees it was newly constructed and sold for a profit, they will write you a $24,000 check. This is not a way to make friends, just to be clear. And they will go after the seller for HST on the whole house. We have a client, true story.
Sorry, even if the client, the seller,
Mhm.
that's their primary residence, that they've built it with the intention of them moving in, but have decided because of the expense to sell?
So you, in order to qualify for this exemption, read what it says very carefully, okay? The second bullet. After construction, the building is used primarily as a place of residence for the individual. Individual related, former spouse, comma. There's always a clause in these things for divorce. Okay, so if there's divorce during construction, I have this case right now, so I already let him go. He got divorced towards the end of construction, separated during the end of
That's normal.
construction. He moved in, he's okay. Okay, so, but it says, sorry?
Okay.
Okay, it says used primarily as a place of residence. CRA has correctly interpreted that as you actually gotta live there.
For how long?
That's a match question.
You
So
never
there's
get
no
an answer
definition.
from, you never get an answer from them.
That's okay, so if you
Yeah,
just
yeah.
move in and move in.
I'm here to post red flags. I'm here to warn you about danger zones.
Yeah.
I'm not here to necessarily give you solutions to everything, all your life's problems. But this is a major area of, sorry?
Can we have another session?
Yeah, no, that one we're gonna charge you for. So, but you see with the language here, I mean, CRA is right, it says used primarily as a place of residence. How do you use it as primarily as a place of residence without actually moving in?
Right.
I don't want to, that's not a case I want to take on. Clearly you gotta move in. How long, again, is the magic question. I can tell you from experience, you're talking from the perspective, let's say we're representing the seller,
Mhm.
okay? And the seller,
And the buyer talked to you and they got their $24,000.
oh, then they're in big
They're
trouble.
screwed.
Yeah, so this is a true story. We had a case where the buyer, in our case, I represented the seller. The buyer was employed at the Canada Revenue Agency.
Huh.
A true story. He applied for the rebate, got a $24,000 check. My client got a $200,000, and he remembered the guy too because he came to the open house, and the real estate agent, not too savvy. The guy walks in and goes, "Did anyone ever live here?" He's like, "No, it's brand new. No, everything's brand new. We totally got the place." "Oh yeah, we got the place. Yeah, okay." Puts in an offer. CRA employees don't make that much money, but this guy obviously either married rich or inherited money because he bought a $2 million house, and my client's got a several $100,000 surprise. Okay, and this is to your point. Sorry, what's your name in the back?
David.
Heidi.
Heidi. Heidi's made a good point. You can't fool CRA and just say someone lived in the home. They get the water bill. They can ask for the water bill. I know you shower. It's 2019. And the thing is, if you're buying a $3 million home, I know you have internet. Nobody is living in 2019 in Toronto in a $3 million house without internet. Like cable, I can agree. Okay, you use Netflix. Okay, I can get my head around
Steal the
cable.
neighbors.
But they're gonna get the hydro bill. Hydro bill.
Lights on.
You gotta have lights on. Okay, and then their best friend now is Google Street View. Google Street View is the best. It shows when the house was. It's time stamped. You can go back in time on Google Street View. It is insane, but they're looking. These are huge dollars we're talking about when we're talking about $3, $4, $5 million properties. We had a client. I think this is like a $2.5, $2.6 million property. We didn't represent them at the audit. They didn't believe me when I told them they were in trouble. They came back later and now we're working with them. But they said, no, we live there, CRA, excuse my language, they call BS.
Yeah.
And then CRA said, we don't believe you live there. And they could prove it. YouTube is also a wonderful thing, okay? Post a video of YouTube on the house, there's obviously no one living there. Okay, so they got a bill for $279,500, and there was $56,000 just in interest on that,
Why?
because it's 3 years ago. Remember, CRA is always back in time. They're going to charge you interest for the last 3 years. And HST, there's also a
didn't know,
quarter of a
but you're
penalty,
getting
quarter
ridiculous
percent
what they get away
penalty
with.
per month for non-remittance. So the penalties and interest will be huge.
The same for our income too, right?
Sorry?
When we collect as HST people.
Yep.
Canada.
Yeah.
Yeah,
I got hit that last
Going to
year.
Luxembourg?
Yeah, penalties and HST penalties, I mean, you literally, the construction mortgage looks generous compared to HST. It's bad. HST is not something you want to trifle with, and the problem, I'm a positive person, I tell this to my son, I'm a positive person, you get to know me, you like me, and I don't want to be here just,
Aside
you know,
from talking about the CRA.
exactly, I know. This gets worse, okay? This is collectible. So CRA cleaned out our clients' bank accounts for a while, so Scott. It's collectible. Once you get an HST assessment, CRA can engage in legal action. They're gonna put a lien on, they put a lien on one of their rental properties for just a certain amount of money. And now we've spent a year, we've knocked this down, a fair bit. But they're going to pay something, there's no doubt about it. Okay? We can do some math on it, but it gets ugly. And HST, the requirements to prove HST expenses are very difficult. There's a specific regulation for input tax credits that says what you need to have on an invoice in order to claim something for HST purposes. Income tax doesn't have the same requirements, but if you pay cash to labor, electricians, you can have a real tough time claiming it.
You're screwed, yeah.
Yeah, you got a real tough time claiming it. So, and there's so much activity. This is,
Well, that's the underground
Huge.
project, right? So-
well, it's, they're going after the S, they're going around, the trades are next.
Yeah,
So,
yeah.
I mean, they're not, CRA is literally keeping a list of all of the, after they do these audits, they get a list of the trades, because for most part, what happens, the homeowner can't pay this bill, it's ridiculous. They use us to negotiate with the CRA to get as many expenses as they can, and that always entails telling them who you paid cash to, usually how much, and trying to make a deal on some of the cash. So, not to pile on some more bad news, Heidi. It's bottom bullet.
This guy's a happy guy.
It's,
I know
usually
you're probably
the-
really friendly, but.
I know, I'm sorry, I swear. There's no limitation period, which is the scary part.
Yeah.
So 10 years later,
In theory, yes. And I'll tell you why. So we talked about the date at the top of your notice of assessment. These people never filed for HST, there's no date. And if there's no date, the clock doesn't start running. And some judge realized that, and he's right. If you don't file for HST on a house like this, and CRA says you should have filed for HST and subject to HST, there's no limitation because the clock never started because you never got the date. Like for example, if you never file your income tax return, CRA could ask for it in 5 years. You never file. This is very ugly, and this is happening. It's all over this neighborhood. We're Young and Lawrence. You could drive through these neighborhoods. You can go on MLS, the history. You could see who's clearly flipped the house. It's obvious. This is a new neighborhood. Just west of here, we got lots of files in this neighborhood. Just west of here, Avenue and Lawrence, 10 years ago to now,
Yeah.
it's a new neighborhood.
All of Midtown.
All in town, yeah. And it's just, CRA audits like viruses, they spread. Okay, so we're gonna get something potentially more happy. Incorporation for agents, okay? This is something, I don't care who you vote, everyone here should vote. And you can interrupt me with questions, we have a little bit of time. Incorporation for agents would be lovely. There's been, let's give you the third bullet, we don't know when this is happening. But you should all call your member of provincial parliament, tell them you want this passed, tell them you voted for them, I don't care if you did or not. And just tell them they don't know. So tell them you want to pass, because any agent really, if you're making over 100 a year, it probably would pay to incorporate. It'll be helpful. Corporations pay tax at 15.5%. We saw the rates at the beginning of the presentation. That's better than most income tax brackets. And the idea is you're not saving tax like Jersey talked about with dividends paid by your own corporation. You're deferring tax. If you don't need any more money to live on, you can keep the money in the corporation, you can invest it in your business, and you can have a bit of a rainy day fund. You have 85 cents on the dollar left in your corporation versus now when you earn a commission, when you're above 250-ish,
Yeah, that's the top.
$250,000, you have 46 cents on the dollar left. Doesn't make sense, okay? So doctors got in trouble 2 summers ago, if anyone remembers, because they were using their professional corporations to split income with their kids above 18. We had doctors making $600,000 a year, and their family was paying a tax rate of about some family making $200,000, because they were able to split income with their non-working spouse, dividend out money to an 18-year-old kid. First, with the dividend tax credit, how it works is for the kid, about the first $55,000 of income, really you're not paying much tax at all, because you fill up those lower brackets for the kids. Okay, so they put the brakes on that through a program called TOSI. It's severely restricted, but there's still benefits to incorporation for real estate agents. This is a provincial issue, not a federal issue. So you call your federal MP, can't help you. You're just going to talk to him. You call your provincial, or her, I should say. You call your provincial MPP. This has been stuck in provincial parliament for years now. Who knows?
What's the holdup?
What's the holdup? Someone did the math on how much money they're going to lose.
Yeah.
Oh.
Right.
That's the holdup. That's the truth between you and I. I didn't put that on the slide because
So you have
agents don't like me. But sorry.
So you can incorporate over at 100,000?
No. There's no limit to. There's no income limit to a corporation. I'm just saying certainly over 100 grand it makes
Over
sense,
100.
right?
I
That's
thought it
when
was
it
200 before you
Really?
went to that.
But any
no.
income you can, and you recommend that we should.
Yes.
Yeah.
Well, you can't.
Oh, you
Real estate
can't yet.
agents cannot incorporate right now.
Unless you open your own
Okay.
brokerage.
This is
Unless
what,
we all go
if this is
down
passed, you will be able
Or
to
open your own
incorporate.
brokerage. Open your own brokerage.
Well, sure, yeah, pause it, when it's passed, yeah, when it's passed, okay? When it's passed,
That's
so,
what they're doing.
but I'm always amazed, I mean, listen, call your member of provincial parliament. They listen to you, you're a voter. There's a lot of real estate agents in Toronto, you got more clout than you think. I don't know. That's really it on the Tax Fairness for Realtors Act, that's what it's called. Okay, it's amending REBA. And yeah, there's no threshold or dollar figure of income. It's just certainly over 100K starts really making sense. Unless you got a Maserati in the driveway and 3 kids at private school and you really need that money, I mean, that's fine. Don't incorporate it. It's not going to save you any money. If you can't leave money in the corporation behind, that's not going to happen.
Mhm.
Okay, and then Jersey's going to talk. Any questions? Hopefully we raised some red flags. Then Jersey's going to talk about non-residents.
So just a few points about non-resident buyers. Some of you may have foreign clients. So number one, you should know is that there is a 15% non-resident speculation tax introduced, I think it was last year, by the province. It's not income tax, it's just tax on top of the purchase price that needs to be paid by closing. And this applies to non-residents who are not Canadian citizens. For those who buy rental properties, income properties, what they should be doing, the non-residents, is to register for non-resident account number and start with paying 25% withholding tax on gross rents every month by the 15th of the following month, or they can get a person that will act on their behalf as a Canadian agent. Basically, it means that they put their name on the application saying that, you know, I am the one collecting rents. Doesn't have to be the case. And then they can apply to pay withholding tax based on 25% of projected net income. This may come in handy when there's no, no cash flow at all, like there's zero income, which is possible. At the end, you will pay the same amount of tax. So the question is whether you want to pay 25% of gross or net upfront. Foreign buyers, they very often were not informed, so they didn't know that there was an obligation to file a tax return. So there is a late filing policy for them where they will be exempt, or the late filing penalties will be lifted, but they will be subject to interest on unpaid withholding tax, and that can add up. For those foreign buyers, non-resident buyers, I should say, selling the properties, they are subject to tax compliance certificates. What it means is they need to obtain the certificate to sell the property, and they can apply for the certificate as soon as there is an accepted offer signed, and no later than 10 days from closing, subject to penalty. Until this certificate is obtained, the real estate lawyer should withhold 25% of the sales price until the certificate is obtained, and then the withholding tax for the certificate is 25% of the gain. Not counting sales costs such as real estate commission, that can be claimed filing tax return the following year. This is something very important, so you probably should ask your client if they're a non-resident, because I've seen cases where the lawyer didn't ask, and then what happens is if the non-resident seller gets his money back and leaves the country, then the buyer is on the hook. The Canadian buyer will be on the hook for.
How do you specify a non-resident? What's the qualification?
Right, so non-resident for tax purposes is somebody that's not residing in Canada and not paying taxes, income taxes in Canada. There could be, generally what it means is they resided at least more than 183 days of the year outside of the country, and they cut ties with the country. So this is a little fluid, the definition, but
Case by case basis.
Yeah, that's why
case
it's
by
hard
case basis.
hard to
But
do.
when you leave to another, you move to another country,
Yeah.
you live there, and you make a living, look at some income. You're not declaring that income in Canada. You're not filing tax returns.
Yeah,
That
but
means that
they-
you're non-resident.
So in another country, so I'm in Hong Kong and I earn money there. Do I have to declare that on my Canadian?
Yeah.
It depends. You could be dual resident for tax purposes.
So I gotta pay tax on the money in Canada and in Hong Kong?
Yeah, but you will get a tax.
Pay.
Like
You-
the States,
but
but you're
Yeah, you
American,
get credit for
always
what
have
you
to
paid in
pay
the other
that.
country.
Right.
So,
Oh,
You will get a foreign tax credit
uh-huh.
if you earn income in a country that has a tax treaty with Canada,
Mhm.
but you will not get everything. There is a cap to how much foreign tax credit you can claim.
and you can forget about a refund. It's not, you're not, CRA is not paying you a refund.
CRA will
You
not
paid another
refund
country
you
too much
the
tax.
money for tax you paid somewhere else.
So,
So the bottom line is, just because you resided in Canada, outside of Canada, say for 6 months, 7, 8 months,
Yeah.
doesn't mean that you're a non-resident for tax purposes. It usually takes more than that. Such as, you left the country, you sold
Let's say he's like a hockey player. He plays for an American team.
there's actually a clause, there's clauses in the, it's funny you mention that, there's clauses for athletes
Oh,
in the Canada-US tax treaty. And Tom Cheek was one of the leading cases, actually.
Cool.
Yeah, he didn't find it so cool, but I thought it was cool too.
how about entertainers then? Same thing?
And it's hockey players and entertainers, like athletes and entertainers.
Yeah.
They have clauses. Most of them live in the off season in Florida, so no personal income tax in Florida.
I have a question when it's the other way around. When somebody moves to Canada, has a work permit,
Right,
and they want to buy a house.
Mhm.
will they be seen as non-resident, and at which point are they seen as a resident of Canada when they have the permanent
Okay.
resident?
And can they get a refund?
Right, so when they move Canada in order to take a job, that I assume they have a job
Let's say
permit.
they have a work permit
Right.
and a full-time position.
So they will be assigned a social insurance number,
Mhm.
and they will be considered the tax resident of Canada. They will file a tax return in Canada,
Mhm.
so they will be considered a tax resident. If you're asking me about the 15% speculation
Foreign
tax,
buyer's tax.
that
They still
gives
gotta
a
pay.
different definition of who's resident or
They
non-resident.
still gotta pay.
Right, and well, not necessarily, so it's a case-by-case basis here. But somebody taking a job with the residency would probably qualify for an exemption.
Like, for example, like John Tory wanna get Google Maps and all those guys working here, right?
Yeah, they're buying places here.
Yeah,
And they're
but-
moving here with
yeah,
a
like,
permanently. They're-
yeah, but
they're
how would
making-
those guys wanna live in Toronto? They gotta pay all this tax to move here.
What do you mean, income tax, personal
No,
tax?
no,
No.
they're
Is that
non-resident
Yeah,
tax,
so the
Exempt?
15%,
Yeah.
there's, first off, we don't do.
foreign buyer's tax.
The 50%,
Yeah.
Roberts is speculation tax.
Yeah, like,
We-
why
first
would
off, we
John
don't
Tory
do-
invite these guys
yeah,
here?
we
They
don't-
can't live here.
It's, they can live here.
They can't
We
buy.
want them to come here. We're
Yeah,
gonna
but
lots of
they
money.
can't afford to buy it.
So, that's a separate issue. The
Yeah.
price of housing has got nothing to do with CRA, or if you can
Yeah,
touch
okay,
that. But the
okay.
15% is, there is a rebate, you can get it back after a couple of years. If you live here for permanently, you can get there's a rebate program that I know about, we did one re-application.
Did you get the money, did they get the money back?
It's
He will.
He's only been in
we'll
effect
get
2
his
years
money
now.
back, he's clearly
That's like
resident.
the
But-
Norwegian.
Yeah.
He
So-
will-
I asked the finance minister,
Yeah,
in last year, and.
We had a situation.
The Ontario finance minister, and he said, oh yeah, but we don't know how we're gonna do it.
that's alarming.
Well, that's the government.
Yeah.
That's alarming. That was very similar to the most recent announcement about a new home buyers program.
Exactly. Yeah.
And
Yeah,
they,
they did
they
that.
said,
They
well,
don't know.
does the mortgage company own 10% of your house? Do they get 10% of the profit when you sell it? They said, oh, well, we're gonna work that out.
Well, when David Miller brought
It's
in
highly
the,
disturbing.
when David
Anyway,
Miller
so,
brought in the
uh,
Toronto tax, he thought the sellers were paying for it.
It's, he was wrong. So, the 15%, the problem really is that there's no cases out, because it's so new.
Yeah.
There's no precedent, I have no idea. Here's the regulation, I mean, here's some comments on it from the Ontario government. I have no idea how a judge is gonna interpret this, no idea, there's no precedent. With capital versus full taxation, I got 1,000 cases to look at. Goes all the way, Happy Valley Farms is the biggest case that everyone cites, it's from 1981. So there's a whole body of cases, how judges guide us on how to interpret the law. We don't, I mean, we're recommending, we're pushing this to the real estate lawyers primarily because land transfer tax and this kind of tax is their responsibility because it has to be remitted at closing.
Purchase, yeah.
And some real estate lawyers, they'll call us with like 10 minutes left. What are you doing? I'm not answering this question, you know? So,
Well, like in
Another
Vancouver, it
issue
was,
is,
Too much.
Yeah. The current premier said that he doesn't like this tax, so it
Yeah.
may even
it may hopefully
be
disappear.
around for that long.
Sorry, who doesn't like it?
Doug
Doug
Ford,
Ford doesn't like it.
Oh, that Ford doesn't like it?
right, that's what he said.
So,
One thing he doesn't like?
Doug Ford likes realtors.
yeah. Yeah.
I have a question.
Sure.
I know someone who is from China. She was a visitor when she purchased the property. So this is like about 4 years ago. And she has applied since, she has applied for permanent residency, and it's in the process. And her understanding is that if she sold the house today, before she got her permanent residency, then she will be responsible for 25%.
Of the gain in withholding tax,
Yeah.
yeah.
quite likely.
Yeah.
So, to be clear about that, immigration law and tax law don't always see eye to eye. For example, I have a client who's been here illegally for about 8 years. CRA didn't care. CRA sent him a bill, they told him he needed to pay tax and needed to get an HST number. He's been working as a drywaller here, making close to 100 grand. I think now he's legal, but he was illegally living here for a lot of those years. CRA did not care, wasn't even a factor in their consideration. He's earning money here, he needs to pay tax, he needs to pay HST. Similar, CRA doesn't care if your income is criminal, in theory. If you're selling illegal drugs, you're supposed to be charging HST. It's a joke, but It's true. There's nothing.
As
Other-
long as they get a piece of it.
Yeah, CRA, well, CRA was doing big business in marijuana, it sort of slowed down as you noticed. But, what the point of the example really is to say that other areas of law don't necessarily translate to tax as well as you think. Criminal, not as well as you think, and immigration is not a factor as necessarily. You can be here illegally and still be considered a tax resident of Canada. Does that make sense?
Yeah, that's for her.
Sorry?
So if you're
You could be here illegally,
My mind doesn't make much.
yeah, but they don't talk to each other. Like Immigration Canada and CRA, the left hand doesn't talk to the right, and they're different pieces of legislation. There's nothing in the Income Tax Act that says, in order to pay taxes here, you gotta be, have your PR card or PR, whatever, the immigration status.
I guess the point, I guess the point that she was getting at was that she's a non-resident.
Quite
According to her,
Yeah.
you know, like she was a non-resident when she purchased the property, and she
Yeah.
had a visa, her visa was for 3 years, multiple visa, and then now she's applied for,
Where does she live? Where does she now?
she's in North York.
So she lives in Canada.
Mhm.
She could be
She
considered
could
a
be
deemed
too.
resident of
That's
Canada for tax purposes, but
Yeah.
I don't know.
Yeah,
It is.
a judge looking at residency will look at anything. They're gonna ask where are your kids, where's your dog, where's your parents. They're gonna ask all those questions to determine whether or not you're a tax resident of Canada. Jersey and I have a client who's outrageously wealthy, he's a super nice guy. He's tax resident of Canada because he doesn't stay put for more than like a month in any country on the world. He FaceTimed me, he was skiing in some sand dune in Dubai or something crazy like that. It's insane. But he's just rich. He loves his life, and all the power to him. And I really like him actually. But just because he's not here for 183 days a year doesn't mean he's not a tax resident here. His parents live here. He has a house here. Just because he travels the planet doesn't mean he's not tax resident of Canada. He has like all of his investment broker, for example, his investment broker's here.
Means we want to be.
Does that make sense?
So this person,
And you look at everything.
Yeah.
is she filing tax returns in Canada? Does she have a social insurance number?
She does have social insurance number, but most of her income is from China. So she has businesses in China.
Mm.
Yeah, and I believe that she files taxes in China.
Sounds like a-
For sure, she's Chinese sourcing of
Yeah.
tax
Every
source.
stick has,
Sounds
two
like
ends,
she's
so here's the thing. If she wants to be exempt from the 25 non-resident tax, then she's
She'll
gonna
pay
have
tax
to
here.
declare her Chinese income and pay tax on it.
Mhm.
Or she pays 25% on the disposition and not pay tax on the income she has from China. See, there's,
Come take two ways, right?
Yeah, you can't have your case on you too,
But
exactly.
still, her income is not from Canada, that's the thing.
Yeah.
Thank you.
okay. And
We have a
our
funny
last
question.
slide.
This-
It's literally true.
I have another question. Can I ask you a question? I have some people who are interested in purchasing properties here in Canada, but they're not even in Canada, never been to Canada.
Right,
How does that work?
so,
Or does it work?
so they can buy a property, somebody can buy it for them with, power of attorney to sign, offers and whatnot. And then just buy it. If they buy it for personal usage, that's the end of it. They buy it for rental.
Yes.
Then they have to
Beginning of the
register for
nightmare.
non-resident tax, and pay withholding tax on rental income, 25% of gross rents, unless they get you to sign the application to remit 25% on projected net income. See, when they get a Canadian agent acting on their behalf, then they can be exempt from 25% of gross. Instead, they would be paying 25% of net. And this is only withholding tax, because at the end, they file tax returns, claim credits for whatever they paid, and claim expenses and get the money back.
And normally sorry to interrupt you, pardon.
Go ahead.
No, we have you'd be hard pressed to find a country that Canada does not have a double taxation treaty with.
Iran.
Iran. Very good.
That's one of them, there you go. All right,
Yeah,
I have the
Sorry.
best one.
you're the best one, yeah. No,
Nuclear
there's no,
weapon
no.
and all.
They're still gonna pay the
But
So no, I do have two people who
Yeah.
are interested in purchasing property, and I wanna know what they're paying, and they don't have a visa to Canada, they can't even, they have to apply, it's gonna take them 3 years to come to Canada.
yeah,
They're still gonna pay the 15%, right?
look,
Yeah.
we have lots of people.
Their clients.
Reality is that their money's safe in a house here. Nobody's coming to take the house.
Yeah.
That's true.
50%.
So you're paying
15%?
for a price of
1.5.
security.
Yeah.
That's how you sell it.
They're still
Yeah,
gonna
our
pay.
taxes.
On non-residents, on the purchase,
Yeah?
yes.
On the-
Oh, yes,
okay,
yes.
okay.
Until they arrive, if they ever get a visa,
But if they move here, work permit, family,
it's different.
Right,
full
so,
job, they, social
Family's
insurance
a big
number,
one.
they start to pay taxes right away, they would be exempt from that.
from the
Quite,
15%.
Yeah.
quite likely if they
Quite
start
likely,
fighting,
yeah.
quite likely, yeah.
This is
Well, this is a mirror.
Kind of.
Basically, kind of.
But, can I ask a question? Let's now talk about how can we avoid if the parents, rich Chinese parents, and the kids are here for the school, if they want to buy some condos and so on, how can I avoid paying the 15% tax?
Well, there, okay, so,
Corporate, I heard
kids.
some people opening a corporate business with Canadian
Okay, so
shareholders.
here's the thing with the corporation. The corporation has to be a resident corporation.
Right.
So, meaning that controlling stake of the corporation has to be owned by a Canadian resident for tax purposes. So the non-resident who sets up the corporation could not have more than 49% of the shares.
It won't be capital
But
gains anyway.
but that's possible.
That's right, and you're not gonna get the principal residence exemption
Yeah,
anyways.
because of
It's
corporation.
owned by a corporation.
But isn't that what they're doing? They're putting it under their children's name.
Yeah.
Their children are
Right,
here
the
studying, they're
children,
holding the
correct.
15% and then they rebate it back.
Yeah, can I, for the corporation angle, doesn't
It
matter.
doesn't work.
Doesn't work? Okay.
No, it worked, in theory it could work, but you may not want it to work, because if the student ends up staying and living here, they get the principal residence exemption. If you pay 15%, and let's say that person's here for 7%, you're telling me a property in Toronto is not gonna go up 15% in 7 years? There's no way, it's gonna go up way more. You're gonna lose whatever you gained, whatever you saved on the front, you're gonna lose it on the back end, you can't claim the principal residence exemption. Does that make sense? So I agree, a lot of our tax planning and our tax rules,
Suck. But
we interpret them as, no, I'm not telling you everyone's gonna go up or it's gonna crash. Like, these are the laws currently, this is how you're gonna be taxed currently. But that one you gotta be careful of whether or not you're gonna, you're gonna avoid something on the front end and you may pay for it dearly on the back end.
So just reading, because I don't really do that, a lot of them, I did
Yeah,
one, the
this is
rebates.
very rare.
So one of them is foreign national who becomes a permanent resident of Canada. So that's one way to get the money back. International student, somebody that becomes an international student, that's another way to get the money. Or foreign national working in Ontario. So you get a work permit.
But you gotta pay it up front first and get it
Yeah,
back. You gotta have the
yeah,
money.
Still have to pay it
And you
up.
can't mortgage it.
And they
That's
hold
why
on
you have to
to
have the cash,
it, 3 years, and you get it back.
Oh, so it's 3 years, right?
at least.
No, you have to apply for the rebate within 2 years of closing, I believe.
Is it?
I'm pretty sure it's 2 years.
Okay.
Immigration takes longer than that.
So then first they pay and then they claim.
Right,
Yeah.
the rebate,
Yeah.
yeah, if you
Yeah.
qualify.
But you gotta have the money
That's
that's
interesting.
up front. That's a lot of money. 15%, right?
Yeah.
Well, right.
So they pay and then they go.
So we have also a newsletter just with a lot of the information we talked about here today. Heidi's gonna be so generous as to let me put them in front of her and some pictures of them. And appreciate you guys coming.
Thank you.
And-
Thank you.